Welcome to Just Minding My Business Media. I hope you are having an amazing day. And I am so excited to bring to you today Ben Mohr, who is a trusted leader in retirement and income planning with a strong focus on alternative investments and life settlements. As founder and CEO of Ben Mohr LLC, he leads one of the top firms specializing in life settlement solutions, offering expert guidance for navigating complex financial decisions. Wow. Welcome, Ben.
Thank you so much for having me, Ida. It's been a pleasure meeting you.
Absolutely. Absolutely. Okay. So, this is always a hot topic: money,
Yeah. Yes.
legacy, all of that.
Yeah. Taxes, money. Yes, for everybody, of course.
Yes, indeed. So, what do the wealthy investors do differently than the rest of us?
Well, I mean, one of the areas that you hear all the time, people talking about things like private equity, and they may not understand what exactly that means, is things like private equity or alternative investments are areas where exactly what it means, alternative, meaning it's outside the standard market. Most people, if they have a 401k or an IRA, they're just used to kind of what I call a cookie cutter mold, right? We all know the stocks, the bonds, maybe ETFs, mutual funds, and that's about all they have. And many people don't even realize that there are other options. The average person I know who invests usually will have money in the market. And where's the second place they're going to buy? Maybe they buy a piece of real estate for investment, right? And then that's it. I kind of call that the chocolate and vanilla. They might go get something that's known as an annuity. We've all heard of it. It's kind of like a self pension plan. Those are kind of just the stables that we all grew up with. But people don't realize that there is a vast opportunity out there in the world for alternatives. One that people are very familiar with these days, and I'm not involved in it, is crypto, right? Crypto would be considered an alternative. I'm
Mhm.
not sitting here saying I like it or don't like it. It's not where I work, but that would be a classic example of an alternative. Or, say, buying precious metals. You hear people doing that. That's also an alternative, something outside. We are in a space of life settlements. We can go into that in a bit, but this is where the ultra wealthy will do is that they will take a portion of their money knowing that the market will tank at some point. Most years it does well, but they are hedging against market risk by looking into an alternative space. And almost any person who has a high net worth, you will see, gets beyond the comfort zone of just the market to start looking for opportunities, and they are out there.
Yeah. So now you got to tell us what they are.
Well, our area where we sit, when we talk about alternatives, a lot of places I'll go through, people have heard of crypto, people know about real estate investing a bit, things like precious metals. We see commercials for that all the time. Buy gold, buy gold. Okay, it's pretty simple to understand. There's such things known as oil and gas rights. That's where you can pay to be part of a thing. And if they find oil, hey, you struck it rich. We know all of that. Okay. Our area where we sit in is what's known as life settlements. And this is my elevator speech. What we do is we buy out life insurance policies from elderly people, somebody who's maybe 75, 80, 85 years old, who has some health concerns, and they now want to get rid of their insurance policy because they don't want to pay for it anymore. And they really don't have a need, Ida, right? Their families are old. Why do we have insurance? To protect our families. Well, if you're 80 years old, your kids are probably in their 50s or 60s, you really don't need the death benefit anymore. So what they're able to do is come to our company, sell us their policy, and we pay them a portion. So maybe we buy $1 million policy for $300,000, and now they have that money for end of life care, right? Now what we do is we package those policies into a portfolio, maybe 5 policies, and investors can come in and now own portions of these policies. So you're owning, somebody comes to me, they're going to wind up, let's say they do $100,000. That $100,000 is going to be spread out over 5 policies, and then you get a portion of the death benefit when that person passes away. Sounds a little ghoulish, I know, but that's just the upfront. I get it. But the issue is, if you think about it, it's a win-win for everybody, right? John Smith, 82 years old, doesn't want his policy anymore, doesn't want to have to pay for his policy anymore. So he's more than happy to give it up, and he's getting care for end of life, which is very crucial in these days. We know this, right? And so it's what we call more of a compassion investing. You can be feel good about yourself knowing that that money went to somebody so they could take care of themselves at the end of the life. They didn't want the policy, and then you get paid out when they pass away. It's a win-win.
Mm, okay. Well, that's definitely outside the box.
Yes, yes. 99% of the people I talk to are like, I've never heard of this. But what's so interesting, you were talking about the wealthy. Warren Buffett, probably the smartest, investor of all time, as people would say. I call him like the Yoda of investing, the wizard of Wall Street, as they say. He's owned over $1 billion worth of life settlements over the last few decades and has kind of kept it quiet because people don't really understand and it sounds ghoulish. A lot of big banks have done the same. So what we did as a company over the last couple decades is take what the ultra wealthy have been doing and kind of keeping it a secret and now bringing it to Main Street, right? Giving the average investor a chance to do what these people are doing.
That's very, very definitely different. And I've
Yes.
never heard of it
Yeah.
myself, but I'm
Right.
sure, you are enlightening us.
Yes. Right. It's not hard to invest. I mean, we would sit down with people, we'll go over it, what they I know it sounds to get into the details, but you'd never buy a house if you weren't able to have an appraisal and get a home inspection, right? You wouldn't buy a car without looking under the hood. We have the full what we call life expectancy reports that breaks down if somebody wants to look at them to see done by a doctor that shows you why they came up with it's a life expectancy report. So what they'll do is tell you roughly how old this person will probably be when they pass away, right? And
Mhm.
this allows you to know it looks at family history, health history, social history, and it breaks all those down to say this person might live 4 years or 5 years or 6 years. And that's how we base the investment on. And this is all fully transparent to the investor to come in and look at those reports. So you're not just going in blind. We have all the information you would ever need to really decide which policies fit what you do, just as you would do as if you're looking at a mutual fund. You and I could easily look up a mutual fund right now and see exactly who's behind it and what they're investing in. It's the same idea. It's just a different premise of what the investment's based on. What we stick on this is that there's no stock market risk to this, and it's one of the few investments I've ever seen out there where I use this term where it's a non-correlated asset. Well, what are we saying there? It means that this asset has no correlation really to anything out there, any outside influence, right? Whether it's foreign war issues in Gaza, Ukraine, bombing in Iran, or the tariffs, or any of these things that politics, right? That's what we're seeing in the world today. Is anything politically can pop up on a given week, and all of a sudden you see the stock market drops by 5%, right?
Mhm.
So
Yeah.
guess what? If you own a life insurance policy on 82-year-old John Smith who lives in Alabama, you don't really care about that money on that sense of how it's affected by what's going on politically, what's going on in the economics. The bottom line is you own a piece of their life insurance, and that's it. It doesn't go up and down, it doesn't waver based on all of these outside influences. So, what we like to say is what we offer is no stock market risk, competitive returns, and a non correlated asset not affected by economy, politics, foreign wars, or even things like pandemics like COVID.
Wow. That's interesting. Very, very interesting.
Yeah.
So what happens when the person um becomes deceased, then you collect
Yes.
on
Yes.
insurance. So that's how it works.
Yeah, I'll walk you through a process. As we speak right now, we are in the process. Right before I got on here with you, I just met with my lawyer. Had to drive down, come back because we were made aware recently that one of the people had passed. So now we have to go and get the death certificate, which we have legal rights to because we have what's known as an investable interest on that person. So we have to
Mhm.
go to the court, get the death certificate just like the family does, and just like a family would, we now send in the paperwork with the death certificate to the insurance company. Money comes in, and then we distribute it to the investors. And in this case, it's a $3 million policy that's going to go out and be sent out to about 20 to 25 investors involved in that policy. And their APRs on this are hovering around 16 to 18%. That's annual percentage rate, 16 to 18% on something where they never had risk in the market. Now, as any TV commercial says, what is it they say? Like, it's not that we can't say that you're going to do that all the time, right? I mean, it's hit and miss sometimes, but we usually see clients doing decently well. As we said, competitive returns. So that's the way it works. The other thing I want to mention that people don't realize is they can use their retirement funds to buy into this. Matter of fact, 70% of our clients use their IRAs or Roth IRAs to come and invest in this. We think it's a wise choice there. So that money, when they make it, is actually tax deferred. They won't get taxed on it when they get paid. It'll just sit in their retirement account and will be tax deferred.
Oh, wow.
Yeah.
That, I mean, that sounds like a win-win all the way around.
We like to say win-win. I mean, obviously, then people go, "Oh, well, is this safe and guaranteed?" And I say, "No, the only place you're going to get safe and guaranteed is when you buy CDs, treasury notes from the government, things of that nature." We don't have risks like stock market realistically here. It's longevity, right? We think this person's supposed to pass away in 4 years and they live longer. Your returns then are going to drop. But that's why we make sure you're diversified. We don't want people putting all their eggs in one basket and just saying, "Hey, I'm taking 100,000 and I'm going to go buy that one John Smith policy." We want you to buy five, right? Because that way it decreases variance and make sure that, yeah, you're going to have some home runs and you're going to have some decent cases, and a couple cases might go long and you might see lower returns on that, but blended you're going to see a pretty decent return overall. And the key here is I want to get through to your listeners is that with us, you're not investing everything. It's not a hard decision. We usually only have people invest about 5 to 10% of their net worth. Right. And why would that be? Because it would be completely irresponsible for us to sit down with somebody and go, "Oh, yeah, put all your money in this." Because what's the problem? It's a liquid. Once it goes in, we're not taking it out. But this
Right.
is where you just take a small slice of your money so that when the market has that bad year or the economy is not doing so well, this will make up for those years where it's not going so well. And matter of fact, that Warren Buffett probably has less than 10% of his net worth in this as well. And we just tell people kind of like those old Be Like Mike commercials with Michael Jordan, right? Remember that? I know we're in that same age group, right?
Yeah.
Is Be Like Mike. I go, "Hey, Warren Buffett is the GOAT," as they say, the kids say these days. Is Warren Buffett is the Michael Jordan of investing. So I go always say, why not be like Warren Buffett? If he's
Mm,
doing it, it's something you might want to listen to.
absolutely. So if people want to invest, how do they connect with you?
Right. So we have a national platform and we have a platform in California. The easiest way to get in touch with us would be go to our website, which is lifeassetllc.com. I'll repeat that again, lifeassetllc.com. What's great on there, Ida, is it has all instant information. There's an ebook on what we're talking about there. There's a 15-minute webinar. So if you're a person who likes to look at stuff and follow through, you want to read, we have the current overview of all the policies, brochure, everything they would need, information so that it's readily at their fingertips. We're not the kind of people where it's like, "Give us your email, give us your phone number, and we're going to hit you up." No, our angle is we're here to educate. We want to give that free education to everybody up front because we respect the people who want to hear about what we're doing. And we know that if they have an interest, then they can book an appointment with us on there. Otherwise, hey, we just want to make sure everybody is more informed that whether it's with us or you want to look at other alternatives, as I mentioned, the other ones, which are, of course, competitors ours, that just knowing to have the knowledge that you're not stuck in this cookie cutter mold that your advisor's telling you have to buy stocks, have to buy bonds. That's an area you should have some money in, but it's not the only place. They're not the only store in town.
Mm, good. And it's diversified.
Absolutely. Our term is truly diversified, true diversification. Diversification doesn't mean that you spread your money all over the stock market. True diversification means that you have money working outside the stock market for you as
Yes.
well.
Absolutely. Absolutely. So let me ask you, once the person deceased,
Hmm.
who handles the final arrangements?
Final arrangements in what way? The pay?
Burial, yeah, all of
Oh,
that.
I don't mean to be callous, but this is a transaction, right? When we give the money to that family, as far as our relationship with them is, we're done. Okay. John Smith's family was paid the money up front. Now,
Okay.
all we're concerned about on our side is literally, and I don't mean to be callous, is he still living or has he passed? Okay. So,
Mm.
what we do is we have access to multiple areas to find out if he's still living. One, we have legal rights to call the family, and in our agreement, they have to tell us he's alive. We also
Right.
have access to the Social Security database that shows if benefits have been shut off. But what's funny in this era, Ida, the number one way we find that somebody has passed is we also have access to families' Instagram and Facebook accounts. Because isn't that the way these days that we all find
Yes.
out that grandma or great auntie has died? Is no
Oh.
one does obituaries anymore. It's just on there. So that's how we stay on top to know if the person has passed. Then we contact the family and then we go and get the death certificate and so on and so forth. As far as their arrangements, we're not involved. We don't have a personal relationship with the family. I don't think that they want the guys showing up at the funeral who they know are getting $3 million, Ida. I mean, that's a heck of a bouquet to be sending at that family thing. I mean, that would be a little too ghoulish for us. It's like, hey, sorry, grandma died, but we got to go cash this check, right? You got to have a little sense of humor about this. So we just like to keep this a business relationship. Hey, we paid you, and your family goes on with that money. You guys got end of life care for your grandpa. We're now just going to deal with the outside entity of dealing it on a monetary basis.
Now, what are the ranges of policies that you buy?
Well, it's anywhere from we usually do not try to buy anybody who is, think about this, like we're not going to go buy anybody who's younger, right? Because even if they had an issue because of medical science, right? We know this. Somebody 55 years old can say, "Hey, I have cancer." That's unfortunate for them, but that with medical advances, there's a high likelihood that they might get an experimental drug out there. And we're
Mhm.
looking at this as an investment. We're just dealing with time and age, right? So we want that cookie cutter 75, 85-year-old range. Most of the policies are going to be anywhere from as low as $250,000 up to $3 million. Now, that remember, the investor isn't buying the full 3 million. They might own 1% of that policy. So that's kind of, we like to stay in there. The other thing we don't do is what I call the healthy wealthy, because I've have experience with this in the past. A lot of people go out there and try to buy 10 million or $5 million policies because you can get them actually percentage wise cheaper, because there's not a lot of people fighting to, no one's going to pay. It's hard to bring up $3 million on a $10 million policy. The problem on that is that these are people who are ultra wealthy and can have medical stuff done even in their advanced age to make it go on longer. We deal with policies what I call Joe Six-pack policies, right? People who go to Kaiser, and I'm not trying to harp on Kaiser, but they're just getting the basic medical care that's out there. We don't want somebody who's so ultra wealthy that they have private doctors coming to their house. So we're just looking for the average Joe Six-pack policy, $500,000 policy on 80-year-old guy that if it's the end of the time for him to go, it's time for him to go. And we have found that those policies have been very, very successful. We've had very good success in buying those for our investors.
Okay. Now, and in terms of investors, how
Mhm.
much, what's the minimum and maximum on
Great.
invest?
Great question. So, if you're in California, you only have to have a net worth of $250,000, and the maximum you can put into this is 10% of your net worth unless you're over $1 million. Now we enter the space of what we call accredited investors. Outside of California, because of regulation, you have to be an accredited investor. So, for people at home, listening to this, you have to either have a certain level of income, which we would sit down and research for them, or a very easier way is if you have a net worth of $1 million. That means all of your pensions, all of your IRAs. If you're married, it's a combined net worth. So it's millionaires today isn't what a millionaire was 30 years ago. I mean, I can walk down the street and find a ton of them. is so it you have to be an accredited investor outside of the state of California, and we will go through that process to verify with them. The minimum investment is $10,000 for cash, meaning if you just want to write a check, you get a minimum of $10,000. We try to keep this very small for people so they can get accustomed. If they're doing an IRA, it's 25,000. You might ask, what's the difference? Because we do all the setup fees. We pay for the setup fees on the IRA, and that takes, 10,000 just isn't going to get it done for them. So we want to make sure that we cover those costs, right? I would say the average investor probably comes in for about $50,000 on their first round. That's pretty typical. A cash, they might do 25 to 50, but if it's an IRA, the most cookie cutter thing they do is about $50,000.
Okay. Okay. So say somebody comes with 10,000. Let's choose
Hmm.
a figure.
Sure.
And then they want to invest more.
Yes.
How does that?
Very, very, very typical, Ida, because the thing is that we usually have a new portfolio about every 3 months. So
Mhm.
repeat investment is very typical. So I would say to you right now, if somebody is listening to this and came in and said, "Hey, I want to do hundreds of thousands of dollars because I just love it," I would say, okay, now the greedy guy on my side would be like, let's take it because we make money now. I think that's irresponsible. Most of my clients will come in and buy in what we call tranches, right? So if somebody says, "Hey, I want to invest $200,000, what I would prefer to do is invest that $200,000 over an entire year. So rather than having five policies, they'd wind up having 20 policies, more diversification,
Mhm.
less chance. Yeah, right. It just the more diversified you are, the better, even in this instance. So my dream for somebody who has $200,000 is over a year, we go shopping for them. And by the end of the year, they'd have 20 policies rather than just dumping it into five.
Mhm.
Right. So that's, yeah, it's very common for people to reinvest. And then when we have maturities, our maturity reinvestment rate is over 90%, meaning that people, they may not put all of it, but like, on this one I'm telling you where we've got a $3 million payout coming up very soon,
Mhm.
I would believe that a decent amount of that money, especially IRA money, because they're not going to take it out, they'll get taxed. The IRA money almost for sure will be reinvested in, especially with the APRs that we're showing on this round of 15 to 18%. I mean, how can you argue not in reinvesting? With
Right.
cash, it's a little bit different because some people, life happens. I get all the time, oh, my daughter's getting married. They might take a piece of it to go ahead and do that, and then they want to deal with their taxes, but they will reinvest a piece, right?
Okay. So let's talk about the IRA and how that factors in.
Yes.
Do you set that up or they?
Yes.
Oh, so you set up the IRAs.
Yeah, I'll walk it through because people get a little confused. They think that their only options are the Fidelities, Vanguard, Schwabs. Well, that is true if you are going to be in dealing in the stock market, right? So if you had, let's say, a Fidelity IRA and you met with our company and you go, I love it, and you go to Fidelity and go, I want to invest with Life Asset, right? They'll go, what are you talking about? So you can't invest in alternative investments inside most IRA companies that are the Fidelities because they are focused and based on stock market. So let's say that we have, I like using John Smith. John Smith now is an investor this time, folks. Okay. So John Smith's got $1 million, right? He meets with us and goes, I love it. He's got $1 million over in a Schwab account. What we do is we have to set up what's known as a self-directed IRA, meaning that's a company that only deals with alternative investments, meaning from that space with that account, you can invest in real estate, precious metals, all the things I talked about. So when you hear a lot of people saying, oh, I invest in my IRA in real estate. That's all they've done is they've opened an account with a company that focuses on alternatives. They're just a custodian. Okay. So we
Mhm.
open up over there. We use a company called IRA Club. They're very good at what they do. So what we do is we open up an account over there, and then all we do is fill out the paperwork. And let's say John Smith says he wants to do 50,000. It's what's known as a direct transfer. That money is wired from Schwab over to IRA Club. There are no taxes taken out because it is an IRA to IRA account transfer. There is
Mhm.
no taxes, there's no tax paperwork. It just moves on over. The money is tax deferred, and now he has his $50,000 at IRA Club. And then from there, he can invest with us. So his IRA will own it. It will be overseen by his custodian called IRA Club, and the investment will be with us, Life Asset LLC.
Ah, okay.
Now, when it gets paid over there, What happens is, again, the money just goes into this money market account in his account. He's not taxed. And then we'll come back to him like our clients now and go, hey, do you want to reinvest? Because what's the option there? It's just going to sit in a money market, not making much interest. And I
Right.
find it hard to believe that he's going to go, hey, Ben, thanks for the ride. I know we made really good returns with you here, but I think I'm going to take that 50,000 and go back to Fidelity. That doesn't make any sense. So usually the thing is they're immediately saying, what else do you have for us?
Oh, okay. Yes.
And real quick, if you're a Roth IRA person and we can help do Roths and we if you put money in a Roth and I can show them how they can transfer money from an IRA and put it in a Roth too, the money they make on that is 100% tax free. So if people are looking at Roths and Roth ideas, definitely come to us. The other thing is if you're in annuities and you're stuck in one you don't like, come to us because we can show you how to get untangled there to invest with us as well. So we try to work with people in the areas we know where the pressure points are, and we're trying to help people come aboard and work with us.
Yes. Wow. This is amazing. So again,
Yeah.
how do people connect with you?
Yeah, real simple. If you go to lifeassetllc.com, once again, lifeassetllc.com, you will find all of our information, the webinars, there's an ebook plus the brochure, current offerings, and then of course there is a Calendly link up to talk to me. And they will be talking to me. They don't get some boiler room, whatever. We are a small company of people, so I am available. I am the face of what we do, but at the same time, I want to get to know every person who's looking to invest because we want to be accountable to those people. So they will talk to me.
Absolutely. And I love that. Yeah.
Great,
I
appreciate
like
it.
to talk to um the owners any chance I get.
Agreed, right? It's like you see these things on Instagram and then you see somebody talking on those stuff and then next thing you know you're talking to somebody in the Philippines or India or and it's just like come on, like you're the one promoting it. Why can't I talk to you? Yeah. They
Right.
will talk to me. Yes, 100%.
That's awesome. Awesome. Wow. This is amazing, Ben.
Oh,
I
thank
didn't
you.
see this coming.
No, no. I mean, everybody I talk to, it may not be for everybody. I do dinner seminars, and I will have people come up to me and go, "Well, it's not for me, but this is probably one of the most interesting dinner seminars I've ever been to because it's just a concept that people, when you think about it, Ida, right, it makes sense.
It
It's
does.
like one of those things, like, well, it makes sense, but you just never thought that that was possible." And it is. That's the two things I get from people all the time is number one, sounds too good to be true. Hey, bring it on. I love it. I love the pessimist, right? I got a lot of engineer clients that love to look at the data, let's have a conversation. You say it's too good to be true. I'm going to give you a ton of data, a lot of proof. We have copies of checks. We have testimonials from clients. We've been doing this a long time. Just because you don't know about it doesn't mean it's not true. And that's really the number one thing. And at that point, if they decide not to invest, then it just wasn't for them. But it wasn't because we didn't give them the data, because we have the data and the transparency. We'll let them know what bank we use. We let them know, they can kick the tires. I get it. It's your money, right? Don't just go after. I always say to people, it's the old, trust but verify. If I
Yeah.
say anything here or if it's anything in documentation, I better be able to prove it, or you should hang up the phone on me and go find somebody else. 100%.
I love that because transparency is everything.
And very rare these days, right?
Yeah, it's very,
Yeah,
very rare.
right. Yeah, right. Right.
Sure. Wow, Ben, this has been a very, very interesting
Well,
conversation.
thank you.
And we're definitely going to have to do this again because
Anytime.
this,
Anytime.
yeah, you got me thinking over here.
I'd love to come back. It doesn't just have to be on this. I mean, we can talk about just a myriad of different things that are out there outside the market. There's a lot of people out there who have annuities. I know annuities very well. We could break that down, the goods and bads. There's just a lot of products out there that people don't understand. And what happens is all they ever do is just get the hype, right? It's always, here's what's great about it. I just tell people, why don't we go to the part where it's like, this is where you can get, pardon my French, screwed over in this deal. And
Yeah,
every product in the world, Ida, has something that somebody out there is not going to like, right?
right.
But why not just get to that? Because then you might go, oh, I don't really have an objection. That part doesn't bother me. Okay, well, let's move on. But at least now you're educated, right?
Yes. Yes, and I think people should know the pros and the cons before you make any
Absolutely.
type of decision on anything.
Right. But the problem in our world is everybody's in this hype mode of just telling you everything that's great about it. But you
Yes.
go, okay, but what, okay. And then they don't ever, they just walk around your question. I come from a different angle. I just go, look, here's what it is. Here's what's great about it. Now let's get to the part because the sooner you learn that, the sooner we're going to understand, is this for you? Everything's not for everyone. Right.
True, true,
Yeah.
true. Wow. We definitely gonna have to talk some more. I like talking to you.
I enjoy talking to you too. I know it's fun.
Yes, indeed. So thank you so much, Ben, and thank you, audience. You've got definitely a lot of information here today. So you may have to rewind and listen some more, rewind and listen some more. So thank you so much. I appreciate you and have a wonderful day.